On June 3rd, Sanae Japan's parliament approved 2 billion in emergency spending for a war Japan is not fighting. The money went into a fund with no line items, no project names, and no scheduled disbursement, and almost no one in the financial press noticed.
That's not because the story is boring. It's because Japan has done this so many times that it barely registers anymore.
The 2 billion is Japan's latest supplementary budget, a 3 trillion emergency package that PM Sanae Takaichi announced on May 25th. Framed as a response to the Iran war's disruption of global energy markets. The Strait of Hormuz, which carries about 80 to 93% of Japan's crude oil imports, was effectively closed to commercial traffic after US-Israeli strikes against Iran began in late February. Brent crude surged from $70 a barrel to a peak of around $70.
For Japan, a country that imports 40% of its crude from the Middle East,
So the government responded the same way it always responds, with a supplementary budget funded by bonds allocated to a reserve fund with details to be determined later. To understand why this matters, you need to understand the mechanism Japan is using. The 10 trillion at the center of this package is designated as earmarked reserve funds, in Japanese tokute yobihi. This is distinct from the regular budget. Reserve funds, or yobihi, are lump sum appropriations that the cabinet can deploy without diet approval on a per-item basis. Parliament votes on a total. The executive decides how to spend it.
The regular budget goes through line-item scrutiny. Each ministry submits requests, committees review them. There are hearings, revisions, and documented justifications. The reserve fund process has none of that. Once Parliament approves the envelope, the PM's office controls the checkbook.
That structure exists for genuine emergencies, earthquake relief, pandemic response, a sudden spike in procurement costs. But in Japan, the mechanism has drifted well beyond its intended scope. The 10 trillion in this package isn't responding to a specific, costed emergency. It's a contingency chest whose uses are described in terms like measures related to Middle East energy developments. Language broad enough to justify almost anything.
This isn't unusual. Japan has been running supplementary budgets this way for years. Just 6 months ago, in December, Nisen Asaruv Parliament enacted an 3 trillion supplementary budget, a number larger than the entire annual budget of most developed economies. That package was more than Lux% bond financed and included reserve funds for similar vaguely defined purposes. And the June Nisen Luk package comes on top of a record 3 trillion initial budget for the current fiscal year.
What's remarkable is that Takaichi herself had taken aim at this pattern before becoming its beneficiary. As recently as March 2006, the Japan Times reported that she had identified supplementary budget overuse as a problem that needs to be addressed. 3 months later, she announced one of the largest emergency packages in recent memory.
Her justification was, in a narrow sense, reasonable. The FY21 tax revenues came in about 1 trillion higher than budgeted. Corporate taxes, income taxes, and consumption tax receipts all exceeded projections as nominal growth, partly driven by inflation, lifted the tax base. So the government's argument was that the supplementary budget didn't represent new borrowing. The deficit bonds being issued would replace an equivalent amount of bonds that had been scheduled but were no longer needed. Net bond issuance, the finance ministry said, remains unchanged from the original plan.
Technically, that's accurate. Politically, it's a very convenient accounting frame that the government has now used multiple times. The deeper story here is the gasoline subsidy program, which is the real reason the reserve funds are depleting so quickly. Japan began subsidizing pump prices in January Nibor when post-pandemic commodity price surges sent retail gasoline above levels deemed politically tolerable. The subsidy has been extended, modified and re-extended ever since. Total energy subsidies from Nibor through Arsavu reached $1.8 trillion, roughly $1.8 trillion, roughly $2 billion. The gasoline component alone approaches $2 trillion. In Nibor, with crude prices surging due to the Iran war, the government's
That's the proximate reason for the emergency budget. The existing reserve fund was on a trajectory to run dry within 2 to 3 months. The San Trillion package isn't a new initiative, it's a refill.
Japan is now in its 5th year of price capping a commodity that the global market is pricing higher for legitimate structural reasons. The Iran war made the situation acute, but the underlying dynamic, Japan trying to administratively suppress energy prices in a country with near total import dependency, was already expensive long before February 2010. And each time the fund runs dry, the response is the same: another supplementary budget, another reserve fund, another round of this is an emergency, not a policy.
This matters beyond the numbers because of what it means for Japan's monetary and fiscal balance. The Bank of Japan is in the middle of a cautious rate normalization cycle. It raised rates to %, and analysts expect 1 or 2 more hikes through Nichian Nitishi Likdan. The entire credibility of that path rests on the assumption that the government is not simultaneously pouring fuel on inflation through demand subsidies.
But that is precisely what gasoline price caps do. They transfer price signals away from consumers, maintaining artificial demand levels, and shift the cost onto the government balance sheet, which ultimately monetizes a portion of it through bond issuance.
According to OMFIF, Japan quietly changed its fiscal anchor in April shifting from a primary surplus target to a gradual debt-to-GDP reduction framework. That shift is significant. Japan's gross debt is somewhere between Sanji and % of GDP depending on the measurement methodology. Maintaining that level requires nominal growth to consistently outpace debt accumulation. The new framework gives that assumption a formal policy home. But it also creates more room for supplementary budgets to slip through without triggering formal targets.
This is the pattern that the Japan factor is actually about. Japan's official fiscal framework projects discipline. The main budget process involves detailed scrutiny, primary balance targets, and medium-term consolidation plans. But the real fiscal policy, the discretionary, politically responsive, emergency-labeled spending, happens in the supplements, and the supplements funded through reserve fund mechanisms that bypass line-item accountability are growing larger and more frequent.
Takaichi's reversal isn't a scandal, it's a pattern. Every prime minister who enters office talking about fiscal consolidation eventually discovers that the supplementary budget mechanism is too useful to abandon. It responds to emergencies without requiring a formal policy reversal, it concentrates spending discretion in the executive, and it comes with built-in political cover because opposition parties can object to the process while having no power to block the outcome.
The Shikyu billion that Japan approved on June 3rd will do what it was designed to do: keep pump prices manageable through the summer, refill the reserve funds, and give the government another 2 to 3 months before the next refill is needed. Whether that constitutes fiscal responsibility depends on whether you're measuring against the budget framework or the outcome. Japan is good at the framework. The outcome, as of mid-2026, is its 5th consecutive year of emergency energy subsidies with no exit strategy visible.
If you want to keep up with stories like this, subscribe to the Japan Factor. The question worth watching is whether Japan's creditors, most of whom are domestic, eventually price the gap between Japan's fiscal declarations and its fiscal behavior. They haven't yet. But the BOJ's rate normalization path is making the math slightly less forgiving each quarter.